This wasn't a trade war, it was a competence test. Back in April 2025, the U.S. administration made a very clear promise. Tariffs would bring manufacturing jobs back. Factories would reopen. Employment would rebound. That promise wasn't vague. It was explicit, and it was framed as urgent. Tariffs were presented not just as an economic tool, but as a corrective force, a way to reset outcomes that had supposedly drifted off course. The message was simple: apply pressure and production comes home. 9 months later, the data arrived quietly. According to reported data, U.S. manufacturing employment declined month by month following the April 2025 tariff announcement. Not flat, not uneven, down, consistently. By the end of the year, roughly 72,000 manufacturing jobs had disappeared. What matters here isn't just the number, it's the pattern. Month after month removes the possibility of coincidence. It compresses time. It strips away excuses. It shows direction. Markets don't wait for verdicts. They adjust on evidence. And when outcomes diverge this sharply from stated goals, the story stops being about messaging or intent. It becomes a test of competence. That test didn't take place at rallies or press conferences. It took place in spreadsheets, balance sheets, and supply chains. Today is a very multiple type of the challenges with her brig. What actually changed? To understand why the outcome flipped, the mechanism matters. Tariffs are often described as penalties imposed on foreign producers. In practice, they operate very differently. When tariffs were raised, the average U.S. tariff rate climbed to roughly 14%, the highest level seen since the mid-20th century. That increase didn't land on exporters overseas. It landed at the border, on American importers. Modern manufacturing doesn't run on finished goods alone. Factories import components, machinery, and raw materials. When tariffs rose, costs rose across the entire supply chain at once. Steel, electronics, specialized parts all became more expensive simultaneously. In theory, higher prices on imports are meant to make domestic alternatives competitive. In reality, many domestic alternatives either do not exist at scale or exist at substantially higher cost. Production cannot simply be substituted overnight without sacrificing efficiency, quality, or output. This is where policy theory meets operational reality. Manufacturers faced a constrained decision tree. First option, absorb higher costs and accept shrinking margins. Second option, pass those costs through in higher prices and risk losing customers. There wasn't a third path. Most firms chose to absorb costs initially, not because it solved the problem, but because it delayed it. Prices stayed stable. Customers stayed put. Margins quietly tightened. That choice bought time. It did not buy sustainability. Margins are finite. When input costs rise sharply and output prices cannot rise at the same pace, pressure accumulates. And when pressure accumulates, firms do not debate ideology. They adjust arithmetic. Today is a very multiple type of the challenges with her brig. The delayed effect. This is where timing becomes critical. Tariff impacts rarely hit all at once. Large firms stockpiled inventory ahead of implementation. Smaller firms stretched contracts and delayed repricing. Costs were absorbed rather than immediately passed through. This created the appearance of resilience, but it was an illusion built on buffers. Manufacturing survey data signaled contraction before layoffs dominated headlines. The Manufacturing Employment Index fell below 50, a threshold indicating that more firms were cutting jobs than adding them. That signal matters because it reflects decisions already in motion, not future intentions. Executives described permanent adjustments, reductions in staff, tighter cash flow expectations moving into 2026. This wasn't a sudden collapse in demand. Orders did not vanish. Customers did not disappear. This was a delayed squeeze. As inventories thinned and margins tightened, labor became the adjustment lever. Not because production stopped, but because costs stayed elevated. And this distinction is essential. This wasn't demand collapsing. It was margins being taxed. That difference explains why job losses appeared gradual, then persistent. Inventory buffers delayed pass-through. Once those buffers thinned, impacts intensified into early 2026. The data points to lag transmission, not a one-off shock. Today is a very multiple type of the challenges with her brig. Who paid the cost? Tariffs don't erase costs. They redistribute them. Analysis estimates that the cumulative effect of tariffs translated into a significant increase in household costs, measured in the low thousands of dollars annually. That figure is an estimate, but the direction is unambiguous. Costs flowed through three channels. Consumers faced higher prices. Workers faced reduced headcount. Shareholders faced lower profitability. Small businesses were hit first. Without scale or pricing power, they had limited capacity to absorb cost shocks. Larger firms followed with a delay, protected temporarily by inventory and leverage. None of this required panic. It required math. Higher input costs without corresponding demand growth compress margins. Compressed margins force adjustments. Labor is often the largest adjustable cost available. The outcome wasn't unpredictable. It was mechanical. Today is a very multiple type of the challenges with her brig. Why this went beyond jobs? This is where the conversation usually stops. At employment numbers, at quarterly reports. But stopping here misses the larger signal. Markets don't just react to outcomes. They interpret what those outcomes imply about decision-making capacity. When a policy achieves the opposite of its stated goal, investors don't simply register failure. They assess whether the institutions implementing that policy are processing information effectively. That assessment doesn't rely on ideology. It relies on risk management. The United States occupies a unique position in the global system. The dollar's reserve status allows the country to borrow cheaply, sustain deficits, and exert financial influence. That position rests on confidence. Confidence in policy stability. Confidence in institutional competence. Confidence that decisions are grounded in evidence rather than impulse. When tariffs were framed as a tool to strengthen manufacturing and instead coincided with consistent job losses, that confidence was tested, not shattered, tested. And the response wasn't dramatic. It was careful. Today is a very multiple type of the challenges with her brig. The global response. Reported investor behavior points to gradual rebalancing rather than panic. This distinction matters. Panic looks like flight. Rebalancing looks like caution. Major holders of U.S. assets adjusted exposure incrementally. Pension funds diversified currency exposure. Treasury holdings were adjusted at the margin. These institutions move slowly by design. They do not react to headlines. They respond to durability and trend. Rebalancing occurs when risk profiles shift, not because something is collapsing, but because uncertainty has increased. That explains the pace. No exits, no sell-offs, just adjustments. Volkswagen's decision to cancel U.S. factory plans fits this pattern. The signal wasn't hostility to manufacturing. It was concern about operating inside an increasingly unpredictable policy environment. Capital is mobile. It does not wait for clarity. It prices uncertainty. Today is a very multiple type of the challenges with her brig. What this actually tested. This episode wasn't a trade war in the conventional sense. It was a competence test. The question wasn't whether tariffs could hurt competitors. It was whether the system implementing them understood modern production. Global supply chains are not inefficiencies waiting to be dismantled. They are optimization networks. Components are sourced where cost, quality, and reliability align. Tariffs don't dismantle those networks. They tax them. And when you tax inputs without expanding demand, the burden shows up where flexibility exists. In employment, in investment, in pricing. That isn't theory, it's observed behavior. Today is a very multiple type of the challenges with her brig. Implications going forward. Based on available data and reported trends, the structural pressures remain. Input costs stayed elevated. Demand did not surge to offset them. Employment adjustments followed. Absent significant policy reversals, These dynamics do not resolve on their own. Selective tariff reductions may soften edges, but they do not change the underlying arithmetic. For investors, the signal has already been processed, not as a crisis, but as a shift in risk profile. For manufacturers, the lesson was immediate. Policy volatility carries costs. And for the global system, the takeaway was quieter, but durable. Signals like these do not unwind quickly. They compound over time. Once institutions are perceived as unpredictable, trust does not snap back on command. Competence isn't declared, it's inferred from outcomes. In this case, the outcome diverged sharply from the promise, and that divergence reshaped how the policy environment was priced. From here, the cost of inconsistency goes up.